Now, before we begin, I want to make sure that you understand, first off, disclaimer here, and by the way, I'm not an accountant, okay? Please, 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 talk to an accountant. I have an accountant. I talk to an accountant about this stuff. Like, I'm making a video about what I understand about it, and I'm going to go ahead and do some strategies myself, but at the end of the day, my accountant is the one who should be telling me some of the things I'm doing are correct or not, right? So the accountant is the one I'm relying on. You should rely on an accountant. So got that out of the way. And by the way, hey everyone, my name's Robbie and I make videos on ETFs and investing and what's going on in the stock market commentary. And today we are talking about tax loss harvesting. So you may have no idea what that is, and we're gonna go over it by the end of this video. You're gonna be a pro in it. So I wanna talk about first where this would actually occur. So the thing is, there are different types of accounts, right? So you have a Roth IRA, for example. You have a traditional IRA, right? Individual retirement account, IRA. So if you have money in an IRA, this doesn't apply to you, okay? That is not something you have to care about. Don't care about tax loss harvesting inside of some type of tax advantage account, okay? Don't worry about it. For example, if you have an IRA and you buy and sell stocks within the IRA and you don't take the money out of the IRA, you don't sell the stocks and then distribute the money into, like, let's say your bank account or something like that, you don't have to worry about this because in IRAs, you don't pay taxes when you buy and sell stocks. But if you have a taxable brokerage account, you do. And so what I have is I have a taxable brokerage account. And so when I have stocks I sell, if I make a gain on that stock, I have to pay taxes on that gain, right? And so what we're talking about today is how to get around that. Basically, get some potential tax advantages by having a taxable brokerage account. That's what we're talking about today. So first off, what are capital gains? There's two types. So there are capital gains that are less than a year. That's short-term capital gains. You have taxable gains, capital gains, that are more than a year. So how does that work? Well, let's say you have long-term capital gains. Let's say you bought in January 1st of 2022. And let's say you bought 10 shares of Microsoft stock for $330. And the cost basis of this, $3,300. We're gonna do, by the way, simple math in this. Don't worry, not hard math, okay? A little bit of math is necessary in this, but not hard math. I'm gonna make it super simple for you. Let's say we held this until January 2nd of 2023. That's just over a year, okay? So now we're talking about long-term capital gains taxes because you held it more than a year, okay? And you sell those Microsoft shares for $400 a share, and you had 10 of them, right? So you had $4,000 worth of your money. That shouldn't say cost basis. That should say the sale that this cost basis is $3,300. Typo, okay, typo. Sorry about that. So basically $4,000 is what you sold it for. What does that mean? You have a $700 gain. What do you do now with the gain? You have a taxable brokerage account. You have to pay capital gains taxes. Okay, can you get around this is the question. Well, first, let's talk about how you would actually be taxed on this thing. So basically, again, we're talking about long-term capital gains right now. These are the different rates that you would pay. So for example, let's say you're single. You make less than 41 grand, 41,675, you don't have to pay tax. Very cool. If you're married filing jointly, less than 83,350, don't have to pay tax. If you're in these, you have to pay 15%, 20% if you're down here. You want to talk about short-term capital gains. So this is if you hold it less than a year. I got this, I think, from bankrate.com. And so this is just a table that shows you, and if we go and we say, what if you made $100,000 in a year? How much would you be if you would, let's say you're married filing jointly, okay? Married filing jointly, $100,000 a year, household income, you fall right here. That means you pay 22% in short-term capital gains if you didn't hold a stock more than a year. So less than a year. But if you go back and you say, okay, that $100,000 long-term capital gains, only 15%, right? So what does that mean? It means long-term, if you hold a stock for the long term, you pay less tax, 15% instead of 22% here. First advantage towards holding stock longer in terms of taxes for capital gains. Okay, next up, how do we decide what is $100,000 of income in that situation before, right? So for example, you are married filing jointly and you make 100 grand as your household, which could mean, one person makes $100,000 and the spouse does not work, or both husband and wife both make $50,000 a year combined. They make $100,000 a year. So that's what that would mean. But let's say there's something called a standard deduction that everyone can get. Well, that reduces your actual taxable income in terms of how you're going to file your taxes. That means you're gonna actually have $74,100 of taxable income, not $100,000. So when we go back and we look at where you fall under the chart, you're actually not even on the part where you would be paying taxes at 15%. It's 0%, right? So that's really good. So if you do get a standard deduction, or if you can get your, you have a good accountant, they can get your income down to the point where you wouldn't have to pay any capital gains taxes on the capital gains that you incurred. hey, there you go, right? That could be a very good potential possibility for you. So again, good accountant could go a long way. Next up, what are capital gains for the amount of money? So we have 0%, right? So for that $100,000 person. But let's say you do make more money, okay? Let's say you make $150,000 married filing jointly. Again, you get that 25.9 standard deduction. Okay, you got $24,100 is going to be your actual income. And so where do you fall now? Well, now you do have to pay some capital gains taxes on the money that you take out, okay? 15%. So that's what you got to do. So we go back. What do we got? Oh, well, we're long-term capital gains. The gain is $700. Taxes 15%. You owe $105. Not too much money, but if you have a lot of things, a lot of stocks that you've sold, if you sold something kind of big and you had capital gains on that, well, this could get, pretty big. But the thing is, if you can get around taxes, if the IRS is telling you can do certain things to not pay taxes, why not do those certain things, right? So let's go ahead and take a look at something called tax loss harvesting. That's the main idea of this video today. So let's say you have gains plus losses. So for example, you bought Microsoft, you made $700 on it, but then you bought Tesla and you lost $700 on it. Well, what happens? If you sold both of those in the same time period for, let's say 2022, you can actually pay no tax because gain of Microsoft can offset the loss of Tesla. Boom, $0 in tax. So that's one of the things we're talking about, tax loss harvesting. Do you have stocks that you've sold for gains, and then do you have stocks that are down that you can sell and take some losses and offset what's going on in your taxes, right? And so you might be very happy this year in December if you end up doing this. There's something called a wash sale rule that you're gonna wanna make sure you avoid if you wanna do tax loss harvesting with your investments. So take a look at this. I got this from TD Ameritrade, and it kind of is a nice graphic to help us understand that if you buy a stock and then you sell it, and there's this 30-day window between when you wanna do this tax loss harvesting idea, and then you buy it again before 30 days. So it's gonna wash out and it's not gonna be effective essentially. And so basically the idea is, it says if the same security or substantially similar securities purchased during the period, then the wash sale rules apply. And basically, so that means if you buy Microsoft and then you sell it, let's say, and then you buy it again within like 20 days or something like that, you're gonna still have to pay the capital gains. Basically, there's a wash sale rule, so you wanna make sure you avoid that if you can. We have a carry forward here too. So this is one of the really, really cool things about this whole idea. Of course, it's not cool if you lost money, but might as well use it to your advantage, right? Might as well use it to your advantage if you can. So you can carry forward your loss. And so what this means is, let's say you had Microsoft and you had a gain of $700 like we talked about before, right? So you had gain of $700, but then Tesla, you put more money into Tesla, and unfortunately, you had a bad return in Tesla because it's down 50% so far for the year. And so you had a negative $8,000 loss on Tesla. So what happens? So first off, you're not gonna have to pay the $700 capital gains tax in Microsoft, right? That's tax loss harvested out or whatever. Then you have this leftover, right? You still had this $8,000, so you have $7,300 left. So what happens now? Does it just go away? Well, no, it doesn't. You get to carry forward this into the future. It can offset $3,000 of your ordinary income in a year. And this can be done until it's exhausted. So you could essentially do this for almost 3 years, right? 3, 6, and then the rest is, so $3,000 in 1 year, $3,000 in the next year, then $1,300 in the final year. And to visualize this, we can see it here. So let's say 2023 taxable income is $100,000. Well, you had your tax loss carry forward. $97,000 is going to be your taxable income that you're going to pay taxes on, and not $100,000. So you're going to save some money in taxes, and then you still have $3,000 for the next year. 2024, you have $100,000 of income. Well, you get to track that out. Now you have $97,000 of income that you pay taxes on, right? So you can still utilize some of these losses going forward. And so that's the whole kind of idea of this thing. If you have losses on your investments, try to use it to your advantage, at least to get your taxes down as much as you can. Utilize the benefits that the IRS is giving to people who are in a situation like yours. And a lot of people, by the way, are in this situation, right? Because the market's down so much right now. Okay, there's one other thing I want to talk about called the wash sale ETF hack, or the wash ETF sale hack. So basically, this part here where it says substantially similar security, what does that mean? Well, this is what's interesting. Now, I talk about a lot of ETFs on this channel, right? So VOO is an ETF that tracks the S&P 500 index. You can see it right here. SPY does the exact same thing. It tracks the S&P 500 index. Guess what? The IRS doesn't consider them the same. They actually consider them to be not substantially similar securities. So basically, you could go ahead and utilize tax loss harvesting with VOO, but you don't have to worry about that 30-day window that we talked about where you could get a wash sale potential issue, right? So sell VOO, you buy SPY, boom, don't have to worry about the wash sale. That's what's interesting about ETFs that basically do the same thing. So if you have ETFs where you have gains or losses or whatever it is and you want to do some type of tax loss harvesting on them, don't worry about buying in again too soon, because if you could just have something that invests in basically a similar index that does the same thing, like VOO and SPY, you don't have to worry about that part. So anyway, hope this helps out. So if you liked it, hit the like button, subscribe to see more videos like this. Let me know if you're going to do this. Tell me in the comments below. I'd love to hear from you. Use an accountant, remember.